U.S. government bonds have broken below a 40-year uptrend. Bond prices today are at the same level they were back in 2003, 22 years ago, and all of that has happened within the space of just a couple of years in the most vicious bear markets we've seen on treasury bonds since the 1980s. As I'm going to show you in this video, we've begun the collapse of the government debt market, and it has massive implications for the economy and, of course, investors. Treasury bonds are supposed to make up 40% of an investor's portfolio. So although most won't admit it, many investors today are suffering from huge losses in the bond market. Gold has outperformed treasury bonds by 170% since March of 2020, meaning gold's returns have been almost 3 times greater than treasury bonds. That's a direct result of high levels of government spending that we've seen over the last few years. This black line is the amount of government spending according to the Bureau of Economic Analysis, and just over the last 2 years we've seen government spending go from $3.4 trillion to almost $4 trillion in just the last 2 years, which is the fastest increase in U.S. government spending that we've seen over the last 20 years. And financial markets are increasingly seeing this government spending as a problem. We think this is the primary cause for this outperformance in gold relative to treasury bonds. When the government spends more, they have to take on debt. And how does the government take on debt? By issuing treasury bonds. So when they do a lot of government spending, they're going to issue a lot of bonds, and that's going to make treasury bonds decline in value. Gold supply, on the other hand, can't be expanded overnight. 2024 is already seeing the largest increase in treasury bond issuance, expected to increase to about $1.9 trillion, which is much higher levels than what we saw during the 2008 financial crisis when the government was bailing out Wall Street. And the government is financing this through this decline in treasury bond prices. Now, we actually think that there's a bounce that's coming on treasury bonds and that they're likely to move higher over the next year or so. But over the long run, this breakdown is likely to turn into something much worse. And it's likely that we'll be looking back on this breakdown that occurred in 2022 as the onset of a much larger bear market in treasury bond prices, because one of the key things that's driving this is the decline in the labor force participation rate. It's been on a steady decline since 1999, and at the exact same time, the U.S. government debt has risen steadily over the last 20 years. When I inverse the labor force participation rate, you can see there's almost a perfect relationship between the two. When there's a big decline in labor force participation, it forces the government to increase its debt. As less people participate in the workforce and more people retire, and so there's fewer people that are paying taxes on their salary and more people that are benefiting from Social Security and healthcare, and so the government needs to increase its spending to make up for that. With an aging population in the United States and baby boomers coming into retirement age, labor force participation is likely to continue declining from here, which would probably be accompanied with a rising debt load. Of course, there's ways that the government could avoid this type of debt expansion from happening, but with current spending levels, it doesn't seem to be the case. And so that's why gold is making a massive breakout today. Since October of 2023, gold is up a massive 30%. That's 3 times the annual return of the S&P 500 in just a few months, because investors are pricing major shifts in the debt market. In October 2023, gold miners were our long trade with the highest weighting on the website. And so with this massive breakout in gold prices, we've been able to benefit from this in a big way with our members, as gold miners are also up 30% since then. Now today, gold may finally be encountering some resistance, as you can see here. We're watching this very closely on the website for where we should be booking profits on these positions. Although with the current debt situation in the United States, we think this breakout is going to prove to be a long-term breakout with significantly more upside and many opportunities for gold and silver in the future. But believe it or not, we also have an active trade on treasury bonds on TLT. Although there's the possibility of a little bit more downside in the short term, we think TLT is approaching a major bottom with plenty of potential upside. If I inverse this chart of TLT and plot it against the 10-year break-even inflation rate, you can see treasury bonds are heavily influenced by what the market is pricing for future inflation. And this recent decline in treasury bond prices has been fueled by rising inflation expectations. But you can also see that inflation expectations have been stabilizing over the last couple of years, and they're not showing signs of breaking out right now. Of course, that could change but this is not a concerning look for inflation expectations today. In fact, I can show you why we could see a big decline in inflation expectations over the next few months, which would set up the bond market for a big rally. This chart, for example, is showing the lowest inflationary pressures since 2020 when the economy was actually experiencing deflation. This is a chart showing us the cost that non-manufacturing businesses have. When it's elevated, it means inflationary pressures are hot. When it's low, like in 2009, 2015, 2020, and today, it means inflationary pressures are cool. If we add the 10-year break-even inflation rate on top, it's not telling us that inflation expectations are about to skyrocket. Quite the contrary, it's telling us they should be rolling over. And so treasury bonds could rise. Now, we could be wrong. In fact, in the short term, we're not ruling out a double bottom on TLT before we actually see a significant rally in treasury bonds. So we're currently in the process of accumulating TLT and eyeing these levels of resistance to potentially book profits on this trade, which could be as much as a 30% move up in treasury bonds. But again, over the long run, we think this is going to look like a counter trend bounce in a longer term downtrend in treasury bond prices.